In this video, I'll tell you exactly why the stock market sometimes falls, and we're starting right now. Hey guys, Elliot here. So if you invest in the stock market, you've obviously noticed that it rises and falls, sometimes quite a bit. Now the reasons why it goes up are not really a mystery to even a casual investor. It's well known that public corporations issue shares, and these shares appreciate in value if the companies and their profits grow. Shares can also appreciate on speculation alone, and if enough investors think some company will be very profitable in the future, that company's stock will go up regardless of actual earnings. Multiply that by numerous such companies, along with more shares constantly being issued and purchased, and together you get a rising market. The stock market can also rise due to other factors that have nothing to do with the companies themselves, such as when interest rates get cut or some good macroeconomic data comes in, and as an investor you're always keeping one eye on news from either the Fed, the Bureau of Labor and Statistics, or some other government agency. Okay, so that part we all know. Now let's flip things around. Why does the stock market go down? Well, things aren't as clear-cut this time. On the surface, it seems like it really shouldn't. Some companies may be failing and their particular stock price can fall, but most companies are in fact making a profit and often grow in size. Do they all suddenly have a bad day? Not likely. So why then does the entire stock market take a nosedive when all the companies in the market are in fact still profitable and doing pretty well? And perhaps a much more relevant question to you personally, what do you do if this happens? Turns out the answer to these questions are both simple and complicated. Keep watching and I'll give you a bit of a peek behind the curtain. And as always, if you enjoy this content, please do subscribe and hit that like button. So why does the stock market fall? The reason is described by just two words: supply and demand. Don't forget, the stock market is an actual market, and if enough people want to get rid of the shares of a particular company, then the value of those shares will decline. Of course, the opposite will happen as well if there's enough demand for these shares, and the price will soar. So then the real question is, what influences supply and demand? And more to the point, how is the supply and demand applied across the entire market, causing the share price of hundreds and sometimes thousands of companies to rise or fall? Well, if supply and demand is the easy part of the answer, here comes the more complicated part. It's actually three separate concepts that work together to dramatically move markets. The first concept, much to the surprise of some investors, is the fact that the stock market is both rational and irrational, or to put it more precisely, it's sometimes driven by emotion and sentiment and not hard data. This is important because a lot of individual investors out there can make decisions that just don't make a lot of rational sense. The second concept, which may also be a bit unexpected, is the fact that the stock market is dominated by major institutional funds who hold enough shares to influence the overall market if they suddenly buy or sell in large quantities. Keep this in mind for later, as this is important as well. The third concept has to do with safety and risk, and it's a bit trickier to explain. The overall market, which includes not just stocks but also bonds, currencies, and other investing categories, is roughly divided into riskier and safer investments. Everyone wants to invest in the riskier stuff such as stocks, as you can make more money, but everyone also wants to keep their money safe, such as with bonds, but anything safe will of course pay less. Okay, so now you have these concepts. 1, an occasionally irrational market. 2, a market dominated by major players. And 3, a constant battle between keeping investments safe to protect money and risky to earn money. These reasons are the perfect recipe for occasional market instability, and is why the market sometimes tanks for what seems to be, on the surface at least, no good reason. All you need now is a trigger, and that is the missing piece of the puzzle. Obviously, if absolutely nothing happens that day, the market won't move a whole lot or may just rise slightly. However, the right trigger will cause a major movement up or down. In the case of a sudden downturn, which is the subject of this video, there are a number of likely triggers, and they include natural disasters, wars, and pandemics, as well as sure signs of a recession or bad economic data, such as rising unemployment, a slowdown in hiring, or the Fed raising interest rates. Let's use that last one as a specific example. When the Fed raises interest rates or keeps them high and refuses to cut them, it makes it more expensive and more difficult for companies to borrow money. This cash is very much needed, especially by the high-tech sector, because so much of tech's corporate growth and expansion is financed by borrowing, and the lower the rate, the cheaper it is to do so. This is one of the reasons why the tech-heavy Nasdaq has been most affected by the high interest rates and will be the one to surge the most when rates do get cut later this year. Now, it's pretty clear the Fed will be cutting interest rates in the fall of 2024, but for argument's sake, let's say the Fed not only refuses to cut, but actually raises them again because it thinks inflation is not yet under control. Well, in that scenario, the stock market will freak out and drop, and here's why. Lack of perceived growth in high tech will lead the giant managed equity funds to look for profits and safety elsewhere, and they will move billions of dollars into other assets, perhaps into international funds or debt instruments, or out of high tech into defensive stocks. Either way, a huge sector will lose money and the stock values will drop as these funds buy and sell in enormous quantities. Plenty of individual investors then add fuel to the fire by freaking out that their portfolio is dropping fast and will irrationally sell to minimize their losses. The result is a major drop in the Dow, the S&P 500, the Nasdaq, or all three at once. The bad news on rates is the trigger, then the large funds start selling off their stock holdings to free up cash to buy other assets, and finally small investors notice the sell-off and join the downward spiral by selling off their own holdings to avoid losses. It all stops when share prices drop enough to bring in bargain hunters who are looking for quality stocks at a discount, and at that point the downward spiral loses steam and the markets level off. So what do you do on a personal level during a major market downturn? Well, if you know that certain stocks are from great companies and suddenly they're priced attractively, well, the only answer is to buy and buy some more. Think of it this way: if you love shopping at your favorite store, say Trader Joe's, and for one day they are marking everything in the store down by 25%, would you run out and get some shopping in? Of course you would, and it's the same thing with stocks. Let's say you're investing in Nvidia and Apple, and you've done your research and determined both companies still have a bright future ahead of them. Then a few days later, some terrible inflation data sinks the entire market, taking the shares of both companies down for a day or two or so before rebounding. If you've got some spare cash saved up, you'd be crazy not to get yourself as many shares as you can afford while the price is low, as you know these are quality stocks and they will rebound. About the last thing you should be doing is selling off your portfolio to minimize losses. Don't forget that if your holdings drop, it probably is just paper losses. They aren't realized until you sell what you own, so don't sell it. Let the stocks go down. It just means they're on sale, and as long as you're buying shares from quality companies, a down market is exactly when you should be deploying your cash and picking up new shares. Okay, I hope you learned a lot about what makes stock markets drop. If you did, smash the like button and please do subscribe to the channel so I can keep bringing you these financial videos. See you all next time.